Disclaimer: this video is for educational purposes only and is not financial advice. Always do your own research before investing.
In 1 week, Bitcoin made more money for some investors than a saving account make in a decade. Bitcoin is back above $77,000, recently touching nearly $79,500 and coming within striking distance of historic $80,000 level. In just 5 days, the king of crypto surged roughly 26%. Let that sink in. An asset worth well over $1.5 trillion gained more than a quarter of its value in a matter of days. And Bitcoin isn't even the wildest story here. Ethereum jumped even harder. Billions of dollars in bearish crypto bets got wiped out. And institutional money is flowing back into the Bitcoin ETF at a pace we haven't seen in months. So here's the real question. Is Bitcoin actually back, or we are watching one massive short squeeze that unwind just as fast as it arrived? Today I'm pulling this rally apart piece by piece. 5 forces driving Bitcoin higher, the harder number behind the move, the risk nobody's talking about, and the exact price level I'm watching next, including what it would take for 100,000 to be back on the table. Then I will show you 6 high-income Bitcoin and Ethereum ETFs, 2 Canadian and 2 US Bitcoin plays, plus 1 Canadian and 1 US Ethereum ETF for anyone who wants to crypto exposure without giving up cash flow. Let's get into it. On August 16, Bitcoin was sitting nearly $62,900. By August 21st, it had punched above $77,000, briefly testing $79,500. That's massive 26% move in a single week. Zoom out further and Bitcoin is now roughly 33% above its July low near $58,000. Its market cap has climbed back towards 1.5 to 1.6 trillion. This is Bitcoin's strongest week since March 2024. And it's not moving alone. Ethereum gained roughly 26% over the same stretch, with some smaller crypto assets moving even harder. The entire crypto market added an estimated $500 billion in value in 7 days, reclaiming a total global cryptocurrency market cap of $2.29 trillion. That's not a noise. That's not a random Tuesday ramp. Real capital is flowing back into the asset class. The question is why, and there are 5 reasons. The first catalyst isn't what you would expect. It didn't come from a Bitcoin headline. It came from the bond market. The US Treasury announced its August 2026 quarterly refunding materials, revealing plan for up to $38 billion of liquidity support buyback for longer dated off-the-run treasury securities. In plain English, buying back older government bonds to smooth out the market. On its own, that's a technical, almost boring detail, but investors read it as a signal. Financial conditions may be getting easier. And Bitcoin has one built-in trait that makes it hypersensitive to that signal, a hard cap of 21 million coins that will ever exist. When investors start worrying about currency debasement, expanding liquidity, falling yields, or a weaker dollar, scarcity becomes the trade. Gold benefits, stock benefits, increasingly Bitcoin benefits too. Now, to be precise, treasury buybacks are not Federal Reserve quantitative easing. Those are different tools with different mechanics. But markets don't trade on textbook definitions. They trade on expectations. And the moment investors started asking, are conditions loosening, Bitcoin answered before anyone else did. That's reason 1, liquidity. 4 more to go. Here's the evidence that actually matters. Bitcoin ETF flows, US spot Bitcoin ETF have pulled into roughly 1.9 billion in net inflows over a dramatic 5-day streak in mid-August. Let's look at the daily breakdown. August 17, about 298 million. August 18, another 189 million. August 19, roughly 517 million. August 20, about 606 million. August 21st, another 307 million. That's a massive 5 days positive run. On August 20 alone, we saw 606 million flow into spot Bitcoin ETFs, representing the largest single-day haul since May. BlackRock's YBIT reportedly accounted for around 502 million of that August 20 number by itself, more than 80% of the day's total inflow. Why does this matter more than the headline price move? Because a short squeeze can push price higher for a few days on its own. ETF inflows are different. That's real capital moving through regulated products, making a deliberate bet. Combined spot Bitcoin ETF assets have climbed back to approximately 90 billion, up from roughly 70 billion in June. That's a genuine shift in investor appetite, not a blip. Here's a split I'm watching. If Bitcoin clears 80,000 while inflow keep climbing, that's the one story, a real trend. If Bitcoin clears 80,000 while ETF money starts leaving, that's a completely different story, a trap. Meanwhile, a huge number of traders were betting against Bitcoin. They were short, positioned for the price to fall. Bitcoin started climbing. Those shorts started getting liquidated. liquidated, forced to buy back Bitcoin to close their losing positions. That forced buying pushed the price even higher, which liquidated more shorts, which pushed the price higher again. That's the short squeeze, and this one was massive. One single wave reportedly liquidated approximately 2.7 billion in Bitcoin short positions. Across the broader crypto market, the 2-day short liquidation totally reportedly topped 4 billion, with over 3.1 billion wiped out in Bitcoin short position along during the main 5-day surge. Billions of dollars in bearish bets forcibly unwound in 48 hours. That's why Bitcoin didn't dip gently from 63,000 to 78,000. It accelerated. Short seller become the market's biggest involuntary buyers. But here's the catch. Short squeezes are explosive and they are temporary. Eventually you run out of the shorts left to liquidate, and when that fuels run dry, Bitcoin needs something else to keep climbing. It needs real buyers. There is a political tailwind here too. The Trump administration has continued signaling support for the US crypto industry. In fact, on August 19, 2026, President Trump met with the cryptocurrency industry leader at the White House, urging Congress to advance critical crypto legislation, including the Digital Asset Market Clarity Act. Markets are also pricing in additional regulatory clarity from the SEC and CFTC. Here's why that matters more than it sounds. The biggest obstacle keeping institutional money on the sideline was never really Bitcoin itself. It was uncertainty. What counts as a security? Which regulator has jurisdiction? What can a bank hold? What can an asset manager legally offer clients? The clearer those answers become, the easier it gets for traditional finance to actually participate, not just watch from the sidelines. Bitcoin doesn't need every single regulation to break its way. It just needs certainty, and the market is starting to price that in. One more macro piece. The dollar weakened this week. The Wall Street Journal dollar index fell roughly 0.7% over the 7-day stretch. That doesn't sound like much on its own, but Bitcoin is priced globally in dollars, so dollar weaken has outside effect on how attractive it looks worldwide. Historically, a softer dollar plus improving global liquidity is exactly the environment where risk assets and alternative stores of value tend to perform best. Stack that on top of falling long-term yields and expectation for easier condition, and the entire macro backdrop tilt in Bitcoin's favor. So add it all up: institutional ETF demand, a weaker dollar, potential easier liquidity, a historic short squeeze, and improving regulatory sentiment, all landing in the same 7-day window. That's not a coincidence. That's how you get a 25% plus weekly move. A 26% move in less than a week manufacturer FOMO on an industrial scale. The same people who wouldn't touch Bitcoin at $63,000 suddenly can't stop thinking about it at $80,000. That's precisely when discipline matters most, not least. Bitcoin is stretched after a move like this. Historically, moves this fast and this large don't go in a straight line afterward. Some analysts are also arguing the market is giving that Treasury announcement more credit than it deserved, and that's a fair critique. Treasury buybacks are not unlimited money printing, and once the short squeeze runs its course, those forced buyers vanish overnight. So here are the 3 things I'm actually watching, not just the price. 1. ETF flows. Do institutions keep buying once Bitcoin is trading near 80,000, or does the money dry up right at resistance? Number 2, the 70,000 level. If Bitcoin pulls back and holds 70,000 as support, that turns this from a spike into a base. Number 3, macro liquidity. If Treasury yield resume climbing and the dollar strengthens again, a big piece of Bitcoin's current tailwind disappear with it. From roughly 78,000, Bitcoin need another 28% to hit $100,000. Is that possible? Obviously, it just did 26% in a week. But I'm not going to extrapolate one explosive week into a straight line to 6-figure. The first real fight is at $80,000. Break through that convincingly, hold it, and attention shift fast to the mid 80,000. Then 90,000, then 100,000. Stop sounding like a fantasy and start sounding like a next milestone. But I want to see this confirmed, not assumed. Continued ETF inflow, sustained institutional demand, a dollar that stays soft or weaken further, improving global liquidity, and old resistance holding as a new sport. Keep all of that intact and the path to $100,000 become genuinely believable. Lose it, ETF flow reverse, Bitcoin falls back through 70,000, and this stops look like a new bull market and start look like exactly what it might be, a short squeeze wearing a bull market's clothes. Now, for the income investors watching, this is the part built for you. Maybe you believe Bitcoin and Ethereum have more room to run, but you don't want to hold the coins directly. And maybe you also want that exposure to actually pay you something along the way. There's now a lineup of Canadian and US ETFs combining crypto exposure with option trading strategies designed to throw off large cash distributions. Before the tickers, the single most important warning in this entire video: a 30%, 40%, even 50% distribution rate is not the same thing as 30%, 40%, or 50% return. These aren't dividend in the traditional sense. A large chunk of that cash comes from option premium, and some of it can be returned off your own capital. 6 funds, Know exactly what you are buying before you buy. First up, the Global X Bitcoin Covered Call ETF ticker BCCC on CBOE Canada. BCCC delivers Bitcoin linked exposure while writing covered calls to generate extra income. Global X recently reported an annualized distribution yield around 33% with the trailing 12-month yield near 35% paid out twice a month. Note, there is also a US listed BCCC that pay weekly, so confirm you have the right one for your residency. The trade-off, covered call can cap your upside during exactly this kind of rally. For a more aggressive Canadian option, BCCL, the Global X Enhanced Bitcoin Covered Call ETF, BCCL layers in modest leverage, targeting roughly 125% exposure on top of the same covered call strategy. Its recent annualized distribution yield has run around 44 to 45%, also paid semi-monthly, but the risk stacks accordingly. Bitcoin volatility, covered calls, and leverage all in one fund. South of the border, the Yield Max Bitcoin Option Income Strategy ETF ticker YBIT or YBIT. YBIT uses option tied to Bitcoin ETF exposure, specifically writing call spreads on BlackRock's IBIT, and recently shifted to weekly distributions. The quoted distribution rate has recently sat in the mid 30% range, but watch this closely. YBIT's SEC yield can run dramatically lower than that headline number. Never see a 35% headline and assume that 35% landing in your pocket as a profit. Second, US Bitcoin income play, BTCI, the NEO's Bitcoin High Income ETF. BTCI runs an actively managed call option strategy on Bitcoin related ETFs and pay monthly. Recent distribution rate has sat in the high 20% range with the trailing rate considerably higher. Big income potential, but BTCI has also seen real NAV volatility, which is why total return matter more than the headline yield. On the Ethereum side, Canada's entry is the Purpose Ether Yield ETF, ticker ETHY. ETHY pairs Ether exposure with the yield-focused strategy and use moderate leverage of up to 25%. Purpose has recently quoted a headline yield above 40% on certain ETHY units, paid monthly. That number is eye-catching. It's also incomplete. ETHY has also seen substantial NAV and total return drawdowns. Last on the list, the Global X Ethereum Covered Call ETF, ticker EHCC. EHCC hold Ether-related ETPs and writes call option against those exposure, paying weekly with the recent distribution rate around 30%. One caveat worth flagging, EHCC only launched on April 1st, 2026. That means it hasn't been tested through a full crypto bull and bear cycle yet. The track record simply isn't there. So here's the summary table. We have BCCC, Canada Bitcoin with 33% semi-monthly with high risk. Then BCCL, Canada Bitcoin with 40 to 45% semi-monthly very high risk. And then YBIT for the US Bitcoin and with mid-30s weekly very high risk. And BTCI again from US Bitcoin with a high 20% yield with monthly high risk. Then ETHY from Canada for Ethereum 40% yield monthly very high risk. And then last one is EHCC covering US Ethereum with 30% yield weekly paid very high risk. These figures move fast and they are not directly comparable fund to fund. Always check current numbers before you act on any of them. If your thesis is Bitcoin is going to be 100,000 and I want every dollar for upside, a covered call ETF is probably the wrong vehicle. But if your thesis is I would rather get paid for crypto volatility than just sit on it, that's where these products earn their place. The equation that matters isn't yield, it's a NAV performance plus distribution plus total return. A crypto ETF that pays 40% while its NAV drop 50% hasn't made you richer. It's made you poorer, slower. So is Bitcoin back? It's definitely awake. I'm now ready to call it victorious. What makes this really worth taking seriously is that it isn't riding on a single catalyst. Improving ETF flows, real institutional demand, macro liquidity expectations shifting, a friendlier regulatory backdrop, and a short squeeze big enough to light the fuse. 5 different forces, one direction the same week, that's rare. But the squeeze got Bitcoin here. It's not what it keeps it here. That job now belongs to real capital. For me, 80,000 is the line in the sand. Clear it and hold it, and then 90,000 and then 100,000 become real conversation, not headline. Fall back below 70,000 and my caution goes right back up. So instead of asking, did I miss it? Ask the better question. Has Bitcoin actually entered a new trend, or are we watching investors chase another explosive crypto rally the way they always eventually do? The next few weeks will answer that. I will be watching the number, not the noise. Tell me in the comment, does Bitcoin hit 100,000 in 2026, yes or no? And which of these 6 crypto income ETF do you want me to break down next? BCCC, BCCL, YBIT, BTCI, ETHY, or EHCC?